Hello, everyone. I'm so excited to interview Dalia Barsoum, founder of Streetwise Wealth and Streetwise Mortgages. We are going to do a deep dive on interest rates. Should you get a fixed rate mortgage or a variable interest rate mortgage? We're going to talk about HELOC products. We're going to talk about financing and how to get to yes to financing your next rental property and so much more. Dalia Barsoum is ranked by the Canadian Mortgage Professionals as one of the top 100 mortgage professionals in all of Canada. She is the recipient of many awards, including Women of Influence, Top 75 Brokers. Dalia is a regular writer of Canadian Real Estate Wealth magazine and is the best-selling author of Canadian Real Estate Investor Financing, 7 Secrets to Getting All the Money You Want. I'm so excited to talk to her today. She is so passionate about building wealth through real estate and financing. And so without further ado, let's get to the interview. Dalia, you're a real estate investor, and I know you've been doing this for a very, very long time. I was just wondering if you could give us a quick brief intro of your investing journey and then why you started Streetwise Mortgages.
I basically worked for the banks for over 15 years. And at some point, I was in the wealth management division. And of course, I learned a lot about, investment vehicles and what's what, and got that fascinating exposure. And as part of that journey, and it was around 2008, actually, when the market crashed, I lost quite a bit of my market investments and felt that there is a better way to control my destiny. And that's when I got interested in real estate. Like everybody who started in real estate, I, read as many books as I can, talked to as many people that I could, and, just chewed information and knowledge that is all real estate related. And that's how it all got started. That's when I actually started my first investment, which was in Barrie, and I still hold it till today. From there, building up my portfolio really became more of a domino effect because I found that the hardest one was the first one. It took me a while to actually make that first move. But once I did it and I got familiar with the market and strategy I'm going to use, it was much easier to make subsequent moves. So since then, I've been investing in real estate. How I started Streetwise is really something that I wanted to do for a while. I've always wanted to own my business and be at the heart of something fascinating. And real estate, once real estate spurred my interest, I thought, you know what, I should probably leave. And I was at a point in corporate where I was at a senior level position, but I had growing family. I had a young son. I was commuting to down. Personally, I was building up my own portfolio, and I did encounter some challenges working with lenders. So I tried to figure certain things out on my own. And I thought, you know what, let me actually figure it out on my own, get into something that builds on my past experience, puts me at the heart and core of real estate investing. And that's how Streetwise started.
Wow. So that's a long journey. So that's amazing that you took action and started this brokerage, which is like really amazing for people like me who need people like you who have been there, and done everything as a real estate investor, and just noticed all the nuances with it. So I'm really happy that you started your brokerage. So it's amazing. So I was wondering, with your rental properties, how do you navigate the interest rates and the news with the Bank of Canada coming in, and they're looking to tapering, the liquidity, and they're looking to raise interest rates? What are your thoughts given the GDP? I mean, because you've been in this for a long time, so I really want to see what your perspective is.
Yeah, so so I'm going to comment shortly on the direction of interest rates and all of that. But the common question that I get from investors is this the time to lock in? And should I now lock in given plan for the property? It is one thing to say, you know what, I will not sleep at night when rates go up. And it's another thing to say, you know what, I understand what my future plan for this property is. Yes, rates may rise, but I've run my numbers. I know I can carry it through, and I have a plan on how I'm going to manage it. So if I go to a client and say, yeah, this is a great time to lock into a fixed rate, and their plan is to flip the property, well, guess what? Now they're going to incur huge penalties when they sell that property because fixed rates come with a big penalty. If we're dealing with a real estate investor who is in the acquisition phase of their portfolio and they're likely to recycle equity to continue to grow, which means that they're going to potentially refinance or, go to lenders who offer secured line of credits. If these investors lock into fixed rates, then again, they're going to limit their abilities and plans to invest going forward because they're going to incur large penalties. So the black and white answer about should I lock, shouldn't I lock is, in my view, has to be put into context. What is your plan for the property? Now, once you've taken into consideration your plan for the property, now we get into, okay, what is happening with interest rates? And does it make sense for me to lock on this particular property? And here's what's happening. Interest rates are still relatively low, and even though there are increases on the horizon, in the bigger scheme of things, we're still dealing with cheap money. Let's not forget that. We're still dealing with very cheap money.
Yeah, for sure.
So that's important to remember. The Bank of Canada's recent announcement implied that they will likely increase prime earlier than expected. 6 months ago, we're talking about an increase to prime probably in 2023, later in 2023. Now that's being brought up in the year. So we'll likely see an increase to prime earlier in the year, which will impact pricing for variable rate mortgages. It will impact line of credits pricing. Having said that, when the Bank of Canada increases rates, they typically go gradually. They don't go and do, big
for sure
chunks of increases because the economy has to absorb that increase, right? And during COVID, there are, businesses that took on debt and all of that, and they haven't recovered yet. So they got to be careful about the pace at which these increases take place. So is variable going up? Yes. Is it going to go up, significantly? No, it will go up very gradually. Typically, the bank increases by 25 basis points at a time. Fixed rate is also on the rise. Fixed rate, in fact, has increased already and is expected to increase again, very gradually. In the bigger scheme of things, it will continue to be low. Fixed rates are tied to the bond yields. So for those clients who have a primary residence, here's what I would say. If you have a primary residence and you're keeping that residence for the next 5 years, you're not selling it, you don't have plans to refinance it, and you worry about fluctuations in interest rate because it impacts your monthly budget, then you can consider locking now if you want. However, over the long term, research shows that Canadians have saved more going variable. And for real estate investors, I always suggest that you keep your options open for flexibility because as an investor, cap equity is a big component for your growth. So that's really my take on interest rates and the decision to lock or not to lock and how it relates to real estate investors in particular.
Good. I mean, yes, I know personally, I've gotten myself into a hot mess just locking into fixed rates. And I always find, for me, variable has always been super fruitful. And, I always find like if you go into a variable, you can always convert to a fixed later. So it's not like you need to lock it in right now. So you could play it by ears, kind of like how I play it.
You can, however, when you convert at a fixed later, you convert at the prevailing rates at that point in time, which tend to be higher than at the time you've arranged the mortgage. So yes,
right,
that's always an option, but it tends to be a little bit higher than making the decision early in the process at the time of arranging the financing.
Yes, I think what you're saying is that you need to know what your end goal is, right with each property. Like if your end goal is you don't have another property to purchase, then you may rethink of if you're just planning to actually hold the property for a long time, never sell, then maybe a fixed rate might be the way to go. But if you're planning to use the money to have a HELOC or to do something else, like if you go into a fix, then you convert that to a cash refinance. Like it's really difficult, I find. It's also very costly, like if you want to break your mortgage. So that's the kind of thing you need to know what you want to do with the property, right?
Yeah. And on that note, Tracy, there is actually a strategy that is more of a middle ground that gives you the best of both worlds that is rarely talked about that I'd like to share with you here. There is a product on the street called an advanceable mortgage. And essentially, it's a mortgage that comes with a secured line of credit that where the line of credit increases as you pay down the principal on the mortgage. But here is the key benefit of this product when it comes to managing interest rate risk. If you have this product or you convert to this product, you're able to slice and dice your mortgage. So you can have on one property 2 mortgages. One is a fixed rate, one is a variable rate. Or you can have 3 mortgages. All of them are mini fixed rates. So when you break the individual ones, the penalties are not as large, or you can mix and match any way you want. So you can have combinations of line of credits, fixed rates, variable rates, which is beautiful because, you don't have to choose either or, but if you want some common, some middle way per se, that's a good way to hedge.
Oh, that's pretty interesting. I know you could break your HELOCs into like couple HELOCs, but what you're saying is you could break it into a fixed and a HELOC. Wow, I didn't know these products. So this brings to my question about getting into a HELOC, and you're saying is how I understand it is this essentially like a secure line of credit against your home. And with these readvanceable mortgages, is that a very similar product? Is that what you're saying?
Yes. So there are HELOCs that are static. Regardless of what you do with the mortgage, the limit on the line does not change. And then there are HELOCs that are advanceable, which come as a component of an advanceable mortgage. So as you pay down the principal, the limit on the HELOC increases. That's the product that I'm referring to.
Okay. I guess with all the products that you're seeing, like what are the kind of top 3 favorite HELOCs you're finding are the interesting ones, and which banks do you work with?
Well, we are one of the brokerages that does not just work with lenders who are part of the broker channel. So the way brokers work typically is they access lenders who want to work with brokers. However, our philosophy is to understand all of the products that are investor friendly on the street and to service the client to their best interest. So if their file suits a lender that works best with a lender who works with broker, we will arrange the financing there. If it works with a lender that doesn't necessarily work with a broker but offers the right product, we will actually ask the client to deal with that lender. So the group of lenders who offer advanceable mortgage products on the street are the following. They're typically the 5 big banks. So there are lenders that offer such a product on a primary residence, and there are lenders that offer it also on rental properties. Mm-hmm. So the key lenders are Scotiabank offers a product called the STEP product. That's an excellent product in my view. You've got CIBC offering another version of this called the CIBC Home Power Plan. RBC has also an advanceable mortgage product called the RBC Home Equity Line. TD has one and BMO has one. I don't remember the TD product name, but if you go to TD and ask them about their advanceable mortgage product, they'll know what I'm talking about. And then BMO has one called the BMO Ready Line. National Bank has one called the National Bank All-in-One. So these are the 6 that work in a similar fashion on the street. And then there is the Manulife product, which is also an advanceable product, but it allows you to slice and dice a lot more components compared to these 6. It's called the Manulife one. So all of them are great. Each product has its pros and cons though. Like there is a little bit of a fine print in every one of them.
Okay.
They're not all apples to apples.
Which one's more investor friendly? Like do you always have to pay, for example, interest only, or some's like you have to always pay a little bit of principal and interest, like with the HELOCs? Have you come across like different rules like that? Or strange rule?
On a mortgage, it's always principal and interest with these products. On a HELOC, you can only pay the minimum payment, which is the interest only payment, but you do have the option to pay a principal and interest payment if you want, as long as your line of credit is revolving. Once you convert the line to a mortgage, which is an option, another beautiful feature of such products, you start with a line of credit that is revolving. Maybe you've used $100,000 to invest in a rental. You've been paying interest only. And then at some point, your rental property's income has increased. You can cover a bigger payment. You have an option to go to the bank and say, guys, for this $100,000, I want to convert it to a mortgage. So when you convert it to a mortgage, fixed or variable, you'll start making a principal and interest. And then now this mortgage goes here. And as you pay it down, again, your line of credit starts to increase.
Right. So you're becoming your own bank is what you're saying.
Yeah, it's amazing. I always tell investors, you know what? It's so powerful. Some investors don't see it when they initially arrange it, but as a strategic feature, it is so powerful. Here is something that, just a small tip, even on this particular product, from a long-term standpoint, eventually your rental property mortgage is gonna go down to zero. The rental property mortgage is gonna go down to zero over time. If you have an advanceable line, right, or an advanceable mortgage, well, now you've got all of this money available to you down the road. Maybe you don't want to buy more properties. Maybe you can then turn around, use that line to lend in private mortgages or invest using the Smith maneuver in the markets. Because if you didn't have an advanceable and you need money and your mortgage is fully paid down, the only way to get money out would be to refinance. Yeah. And to refinance, you have to requalify. And to requalify, they are going to look at your income and they're going to look at your credit and they're going to look at the size of your portfolio. So why not set yourself up from the get-go and give yourself access to that capital as you pay down the principal, because you've earned it, in my view. You don't need to use it right away, but at least you know you have it in your back pocket.
Yeah, that's amazing. That's a great strategy. For sure. Actually, my someone in my family had that situation where so good that they had the HELOC. Yeah, no mortgage, but the HELOC is always still there and it's so flexible, right? And don't have to requalify now that you're a retired person. You could be single, it's a pretty complicated process to get qualified for a mortgage while you're retired too, right? So thanks for that. That's a great tip. I guess I'm just going to switch a little bit topics here. It's like now we've talked about like the inner guts of getting a readvanceable mortgage, but I think that a lot of our audience is like, well, how do I even go get a property? And a lot of them are professionals. And I was just thinking, like, way back when I started, the way I paid off my student loan debt and I didn't have a lot of money. So I barely scraped up, enough just to do I think it was 8% down payment, like 5 or 8% down payment into my condo with the intention of actually converting it to rental a couple years later. So I'm wondering, can you still do that? And is this a viable option nowadays?
Well, this is what we call house hacking, right? Essentially, you're buying a property. You will live in the property, but you can create a unit, or you have a unit already that is called an in-laws unit, which is self-contained, that you can rent in the meantime to assist with your mortgage and give you a little bit of extra cash if the rents are high enough. When you buy a property to live in, despite the fact that it's got a rental component to it, you're buying it as a primary residence. And the minimum qualification is a 5% down if you qualify. People's circumstances change over time. They may relocate. They may want to upgrade. And I've seen clients, 2 years later, turn that property into a full rental and buy another one to live in. And that's absolutely fine, as long as they didn't buy the original property to rent with a 5% down. They bought it, they lived in it, was a primary residence with a rental component or maybe no rental component. Then their circumstances changed 2 years later, or sometimes a year later even, I've seen it. That's all legit as long as it's justified and they can move into something else, pull money from the original purchase. Often it would have appreciated, that's the nice thing, and take a little bit to the next deal and turn that one to a rental. But, investors who I've seen investors wanting to get into the rental market and put a 5% down. And that's not a strategy. That is not a legit strategy, because that you can only use a 5% down option, mortgage financing option, if you are going to live in the property.
For sure. Yes.
So I wanted to clarify that point.
I've seen that where people have lied on their applications, right? And to say that they are, not going to live in the unit, which is like obviously illegal, which is not what we're talking about. We're talking about you're living in your principal place of residence, and a couple years down the road, you're like, well, maybe I should consider this as a rental. I'll convert it. And you got to let your bank be notified and let them know that you're converting to a rental. Have you seen that an issue with that, like converting it to rental, notifying the bank? I've never had an issue. So I was just wondering if you knew of anything.
No, I haven't heard of any issues. Where I've seen issues is with people buying the property with 5% down and renting it right away. And then the mortgage insurer does an audit, they learn about it, and they pull the mortgage. That I've seen. But with clients living in the property, for a year at least, and then their life changes and turning it to a rental, I haven't seen any issues.
Say your parents gifted you a down payment, which are so awesome parents, or a relative. How does that impact, title, and how does that work?
Okay. So if you're buying a primary residence, gifted down payment is very, very common. And the lenders just need to see that you're getting a gift from a mother, father, sister, brother, or siblings. That's some lenders allow extended family to gift. They need the donor to fill in a letter, and they need to see just a proof of the money in their account moving to your account. Okay. And some of them call the donor up to confirm that they're gifting the money. So it's pretty straightforward when you're buying a primary residence. If you're buying a rental and someone is gifting you funds, majority of the lenders don't allow it. However, there are a few lenders on the street that do allow it. Some of them are banks, and some of them are B lenders. You still have to go through the same process of completing the letter, your donor completing the letter, showing that the money is in their account, moving to your account. So it really boils down to the lender. Some lenders say, nope, on a rental property, we want to see that you have skin in the game. We're not allowing you to borrow money on top of what we're giving you in a mortgage. And some lenders are okay with it.
Oh, okay. I didn't know some lenders didn't allow it. Even what if it's been in the account for like 30 to 90 days or 6 months?
Well, if the money is in someone's account for 90 days, that's no longer a gift. A gift is when someone, in the middle of a deal is giving someone money, or within the last 30 days is giving them money. That's not accumulated funds. Right. So that would be considered a gift.
Oh, I get it. Okay. Understood. How about on title? How does that work?
Yes. Right. On title. Has nothing to do with title, really. At the end of the day, if you are buying the property and you qualify for the mortgage, you're going to go on title. The fact that someone is giving you a gift has nothing to do with title. The lenders will not mandate them to go on title or to participate as guarantors in the deal.
Do you find that right now, given the stress tests, with the mortgage stress test being the rules are pretty strict, are people hitting a financing wall? Like once they hit 5 properties, like what is the financing wall for people?
Yes. So this term financing wall is misunderstood. Some clients think a financing wall means that they can no longer get mortgages and that's it. And that's not true. Every lender has what we call a wall, meaning with every lender, you will get to a point where you can't go further with them in terms of approvals, whether it's a purchase or a refinance. So when a client comes to us and says, Dalia, I hit the financing wall, my first question is, which lender have you been talking to? Because if you've maxed out with that lender, then maybe there are options for us to clean up, debts or restructure certain things to continue to open up room with that lender until you hit their wall. Or if there are no options with that lender, don't think that you're done, because there are many other lenders in the investor lenders universe that we can work with, and you haven't hit their wall yet. So what determines the wall? Typically, lenders have a limit to start with when it comes to number of properties that the client owns. So some lenders say, you know what, if you already have 5 rentals and a primary residence and a second home, or even 5 rentals only, we are not going to do any more mortgages for you, regardless of whether you hold them with us or with another lender. That's their first discussion point before they even look at your credit and your ratios and anything else. So 5 generally is the first filter. And then from there, they start to look at other things. But there are lenders who cap at 5. Then there are lenders who cap at 10. Then there are lenders who don't care how many properties you have. What they care about is how many properties you have with them. So I've done portfolios that have 30 properties with a bank that only cares about the fact that the client has 5 properties with them. So there are lenders who say, I don't care about who is holding the mortgage. If you have 5, I don't want to talk to you. And then there are lenders that say the same thing at 10 and at 12. And then there are lenders that don't care, but care about you working with them. So that's really the thing. There is no absolute wall. That wall is with every lender. And when it's hit, meaning you got a decline, or you're unable to go further with them, or they're asking you to put a higher down payment, or you're paying more in interest, there are often options to tweak your balance sheet to keep you going. If not, we can take it to the next one or the next one. So we know how to place the deals and manage this, the financing path essentially to maximize on the size of your portfolio that you want to build.
That's amazing. Yeah. I think that was like aha moment when I read your book.
Canadian Investor Financing,
Yeah.
7 Secrets to Getting All the Money You Want.
Right.
Not to buy shoes with, not to buy shoes with, to buy properties with.
Yeah, that's what I was like. I was like, yeah, the 7 secrets. I was like, I loved it because it was the aha moment that got me to you was when you talked about, not hitting a financing wall and that so many lenders, which is I found fascinating. So let's get back to let's say you did hit a no to financing rental property, which I've experienced really early in my journey. And how do you get to a yes? Like, what are the things that typically cause a no?
So the things that typically cause a no, first of all, before I get into that, Tracy, I wanted to share that every lender runs the numbers differently. What do I mean by that? Let's say you have a credit card, not even a credit card, a line of credit with no balance on it. You have a $300,000 line of credit with zero balance on it. Some lenders will say, you know what, in our calculation, we're going to assume that you've used it all.
Oh,
yeah. And some lenders will say, no, we're only going to use what you have used. Okay. Huge difference to the numbers. So if you go to lender one and your numbers are already tight and they're using this methodology, well, guess what? You're not going to go anywhere with them and you would hit their wall. While if you go to lender two, you still have quite a bit of room with them because they're not running the math the same way. So this is just one example, and it goes on and on and on many fronts, even with rental income. You're renting a property for $1,700 a month. You would think that the lender is going to take it all in their calculation. The answer is no. Some lenders will take only 50% of that number. Some lenders will take 80%. Some lenders will not take the rental income on all of your properties, and they will pick and choose which one. So that's the thing. Everybody runs the numbers in a different way. And if you're sitting here and you're only seeing interest rates and banks and lenders marketing their products, and you don't know how they think behind the scene and how they look at things, it's going to be very challenging, especially for investment properties, to actually figure out where to go. You may talk to a bank and they say, you know what, we'll do this for you. Okay, but for the current deal, you'll get it done but from a big picture, you may not be looking at the right strategy. So my suggestion is to talk to a broker who's investor friendly, because we breathe this day in and day out. We are on top of the rules. We know how things are being looked at. So we can look at your file and say, okay, the reason why you hit the wall is because you've been with this lender. They look at the math this way. Here is what we need to do to keep you going. Now, here are the different reasons why people hit the wall. One is, as I mentioned, how the lenders run the numbers. Two, maybe you have simple things that we can actually reshuffle to help your file. For example, one, very common, client has, a credit card, one like an MBNA credit card. I'm not picking up on MBNA, but I'm using it as an example because they send out promotions saying, you know what, take on this credit card, switch your balance from this card to our card. We're going to give you 6 months of interest free, period. Yeah. Right? So some clients utilize that and nothing wrong with it. However, they're not paying interest for 6 months. Great. Now they moved, $20,000 balance from this credit card to this credit card. They're not paying a penny for 6 months. But guess what percentage the lender is taking in their calculation on this balance? 3%. So 20,000 multiplied by 3%, although for 6 months, they're not paying anything. So again, certain tips and tricks. The other one is a car loan. A client has a car with $2,000 left on the loan. Yeah. However, on a monthly basis, they're paying $1,700 per month. The lender doesn't care that they have $2,000 left on the loan. What are they taking into consideration? $1,700.
Wow. Yeah, your monthly payment.
So if I use cash or even secured line of credit to clear that loan, now I've cleared up $1,700 out of the calculation, which makes a huge difference. And again, these are the little things that clients wouldn't know, just being, at the door of the lenders and not knowing how they run the numbers. So that's why clients hit the financing wall. And this is where we step in and take a look at everything and say, okay, to maximize and open up borrowing room, here is what makes sense. Here is what we need to do. Here is, even for self-employed clients, here is how much income you need to show.
So it's been so much fun talking to you. It's always a great time talking to you, getting all your expertise. Now, why don't you let viewers know where to find you
I am the founder of Streetwise Mortgages and recently founded a sister company, Streetwise Wealth. So you can check us out at streetwisemortgages.com and streetwisewealth.com. If you have a question, you can reach me and my team at info@streetwisemortgages.com as well. And if you're looking to, strategize financing, we do something very unique in the market called the financing roadmap, where we can help you look at all sorts of sources of capital, build up how financing is going to look like for your next set of deals, where you can save, how we can maximize your borrowing. So if you would like to have that complimentary planning session with my team, email us at that email address as well.
Awesome. And I'll for sure include the links below this video so you could find Dalia and her team. Okay, well, thank you so much. It's so fun, Dalia.
Thank you, Tracy.
Hello, everyone. I hope you found the interview so helpful. We are going to do more of these interviews because if you are looking to scale your rental property portfolio well, financing is critical, which is why I'm doing this series. If you want to reach out to Dalia and her team, please be sure to click the links below or check her out at streetwisemortgages.com. I'll see you in the next video.